Happy New Year, everyone. My name is Julina Ogilvy, partner and wealth advisor here at Principal Wealth Partners. Welcome to our first market update for 2023. I am welcomed once again by our founder and CEO, Bob Paolucci. Bob, welcome back. Thanks for joining me.
Happy New Year.
Yeah, so I think we're really excited to transition away from 2022. We've talked a lot about how difficult of a year it was for both stocks and bonds. So I'd like to first review where we ended the year, but I think then more importantly, let's talk about some of the opportunities that we see for this year and some of the themes and thematics for 2023.
Absolutely. Let's dive right in.
Okay, great. So let's quickly highlight some of the volatility from last year. If you want to first maybe address the Federal Reserve, which was probably at the heart of all this.
Absolutely. So, you look at the capital markets, and by capital markets, stock market, bond market, global stock market, global bond market, all of the markets, commodities, so on and so forth. There was a tremendous amount of volatility. In normal years, you'll have high volatility in one of those main markets, and it will be less and sometimes significantly less in other parts of the capital markets. Last year, there was a tremendous level of volatility and a tremendous amount of change in all of these sub-markets, whether it be commodities, interest rates, the bond market, foreign stocks, U.S. stocks, large companies, small companies. There's really no place to hide. And that's very rare, right? There's usually always a place to make money, and or a place to hide in the capital markets. And last year there wasn't. So what was really the creator of all of that volatility? And the creator of all that volatility was the largest percentage change in interest rates executed in the shortest amount of time ever in history. So the largest change in interest rates, money being free to money being expensive, executed those changes executed in the capital markets very quickly. So the Fed talked about increasing rates in January. They started to increase them in March, and they increased rates by a little more than 4% from March to the end of the year. Mm-hmm. So we've never seen that before. And to prove it to you, we've put this chart on the screen to show you how unique this move in interest rates was compared to other rate hiking cycles in history. And this one certainly stands out. So that was really the root cause of all volatility in the markets, plural.
Yes. Yeah. And you alluded to this already in regards to the fact that there was nowhere to hide, but can you talk a little bit about what it looked like from a portfolio perspective?
Absolutely. What did that really do? Well, it created repricing in all asset classes. And we're going to illustrate here the most popular asset classes. And if you've been, watching TV or reading any financial media of any sort, you know that the stock market was down. And by the stock market, the generic phrase, most are referring to the S&P 500. Last year, the price return was negative 19.4%. If you held on to it for the year and you kept the dividends and you reinvested them and you didn't take them, the return would be a little over 18%. If you invested in the NASDAQ, the decline was just shy of 33%. But shockingly, and what most investors and most non-professionals, and I'll be honest with you, even some professionals don't understand, is that the real carnage of the market came from the bond market, the market that is perceived to be guaranteed, very conservative, nothing ever goes wrong, because it normally doesn't ever have volatility in it, generated massive negative returns. Now, again, this isn't a reflection of our investors. These are just the indexes. And what we have on the screen here shows that the Treasury index, the most widely invested in Treasury index, is the 20-year Treasury index, returned negative 31%. That is net of the yield from those bonds. The investment grade corporate bond index, just so you know, this is the index that the Federal Reserve started buying during the pandemic to provide some stimulus to the capital markets. The investment grade corporate bond index was down 18%. So these are returns in the bond market that have not happened ever in history. And when you look at the second worst year in bonds, and the third worst year in bonds, and the fourth worst year in bonds, this past year was worse than all of those prior years combined, if that makes sense. Now, this doesn't get a lot of coverage because, when you turn on CNBC, you don't see the ticker screen quoting bonds all day. It's stocks. Stocks are flashy. They're the shiny object. They talk about them the most. The bond market is a game of opposites, right? If yields rise, prices go down, and vice versa. And it's very difficult for investors to understand sort of inverse relationships. But when it's, 20 to 50% of someone's portfolio, I think it should get a little bit more coverage. So this really just shows you underlying index returns, number one. Number two, we created this graph with the arrows showing investors that if you were quote unquote conservative, and let me just provide some color here, conservative is often referred to as more money allocated to bonds than in stocks. Aggressive would be more money allocated to stocks versus bonds, and balanced would be somewhere right around the middle of the road. Well, ironically, conservative investors who had their money invested in more so in the bond market than the stock market shockingly saw a greater decline. Right now, again, this isn't for our clients. This is just using the math based off of index returns. Correct. And literally, it's the indexes that we have up on the screens. So an index investor who was 20% in equities and 80% in bonds very likely saw a decrease of about 23 to 24% net of the dividend yield. Okay. Yeah. An investor that was 60-40, 50-50 saw a return somewhere between negative 20 and negative 21%. And then, oddly enough, the more aggressive investor, who was more in equities than in bonds, did the best, at least of this group. So as defined by, again, 80% equity, 20% bonds, had a return somewhere between negative 19 and negative 20. So I don't think that many investors understand that dynamic, how the bond market was really worse than the stock market. And the level of volatility seen in bonds, again, has never been seen in history. Right. So that is a real snapshot of what went on last year.
Yeah, and it's hard for me to look at these red numbers and not think back to 2008 with the financial crisis, when the stock market fell almost 50% at one point. But if you were 50% in bonds, you had that protection. The bond market was flat or positive, right?
That's right, because the in 07 and 08, which was really, of course, 09 and even into 10, that was a real systemic recession. That was too much leverage. Banking regulations needed to be changed. There were toxic securities all over the capital markets. Nobody was lending. Nobody was borrowing. Right. Unemployment was high. But more importantly, we entered that decline in the stock market with much higher interest rates. And those higher interest rates provided fuel for stimulus. So as Absolutely. The Fed decreased rates, bond values went up. So, you go back to 07, 08, 09, bonds actually had a very good positive return as equity markets were declining. keep in mind, interest rates for the most part started near zero to start last year.
Correct.
So,
Correct. Yeah. Well, thanks for going through this. And you talked about the S&P in general. If you can take it one step further and sort of look under the hood of the stock market last year for us.
sure. Well, you just made it easy for me by putting this up on the screen. So we're cherry picking here, but this is a slide or a screen print from Bloomberg, and this really shows you the largest companies in the S&P 500. Right, generally speaking, to start the year last year, this was number one, all the way through number 6. So Amazon, Apple, Google, which is Alphabet, Microsoft, Tesla, and Facebook, which is now called Meta. Those companies erased trillions of dollars of market cap. And when you look at the percentage change, again, these companies made up about 30% of the S&P 500, or 30% of the market. Let's refer to it that way.
Sure.
And all of these companies performed worse than the market. I would argue that when 30% of the market, these 6 companies, decline by much more than the market, it will take a miracle for the rest of the market to, stand up to these negative returns. So you didn't have 70% of the market, go positive or stay flat while these were down. These were the companies that really drove the market, and all of the peers, all of the other companies, as they fell, all those other companies came down with them. So, case in point, and we're not making a recommendation to say whether these companies are good or bad, but Amazon, Apple, Amazon was cut in half, Apple down by about a third, Google down almost by half, Microsoft cut down by a third, Tesla down almost 70%, Facebook / Meta now down almost 70%, peak to trough. Actually, calendar year, peak to trough was a little bit more. So it was these companies that pulled the market down. Now, in defense of these companies, when you look at their 3-year and 5-year return, they're all still double-digit positive.
Sure.
So when there are resets in these companies, they tend to be pretty hefty. But that creates an opportunity going forward, right?
Absolutely.
So investors that have owned these companies, and this if you've held these positions for years and you're listening, the 3 and 5-year return on Amazon and Apple is north of 20%. Same thing for Google. Same thing for Tesla. Tesla, I think it's still 100% actually.
Mm-hmm.
And for Facebook, the hated Facebook, investors were still rewarded with, above 20% returns over the past 3 and 5 years. So this is just for 2022, but it just tells you some of the widely held, loved securities, when they get over-owned, or in essence, people just start selling the market, the highest weight in the index, these 6 companies, feel it more than the others.
Absolutely.
And they did, and this is proof of it.
Yep. I just bought a new iPhone and I still have Amazon boxes on my doorstep every day. So I think
that's right. And I look up everything.
Yeah.
I look up everything on Google search, and the systems that we're working off of right now are from Microsoft. We have a few employees that have Teslas and many clients on order. And there still seems to be some love for Facebook out there, and they also own Instagram. So
yes, absolutely.
These big brands are still doing what they're doing. Just they're worth a little bit more today. Sorry, worth a little bit less today.
Yes, but it's an important dynamic, I think, to think about for last year and the opportunity going forward. So
absolutely.
One last slide we wanted to share with everyone to recap 2022 was going back to the bond market. You've addressed this, but I think just to highlight just how bad the bond market was last year, we have one last slide that we wanted to share.
Yeah, so this is really bond market returns. This is gluing all parts of the bond market together, but it's a good slide. It shows you the going back to 1976 returns of the world bond market, short-term bonds, long-term bonds, everything in between, glued together. The red dots indicate where during the calendar year the bond market returns went for the year, and the gray bars are where it actually closed, right?
Yeah.
And you can see they're mostly positive numbers, meaning they're mostly gray bars. The gray bars seem to always fall positive, right, above the line of zero. Even though during the year you could see sometimes 2, 4, 5, 6, 7% declines, they tend to close positive. But then you have the far right, which was 2022.
Mm-hmm.
And when you glue all bonds together, you just saw this massive decline. And it was so extreme relative to the past almost 50 years. It tells you that something was going on,
Mm-hmm.
right? It was an outlier event. The bond market was actually doing even worse than what we illustrated to you on the prior slide. But it looked like the bond market actually entered a bull market in October. So if we measured this as of October, it actually looked worse. So you really had about, let's call it 2 months of really good bond performance leading into the end of the year.
Correct.
So this really shows you the outlier event that was the decline in bonds.
We have to address inflation first. This was the major headwind for last year. And we've talked a lot about it in past webinars, but I think that some of the more recent numbers are really worth pointing out.
You're absolutely right. So the Fed, halfway through the year, was relying on inflation to justify the increase in interest rates, right?
Correct.
That worked. It certainly, you couldn't argue with that.
Mm-hmm.
Inflation was rising. And then in the spring of last year, you and I talked about inflation projections going forward. And, when the Fed hits the button and they change the rate of interest, and they change the Fed funds rate, usually takes a couple of quarters to really make an impact. Mm-hmm. Other than the words and the action and the stock market moving.
Right.
Things like mortgage rates, not that they were slow to react because it all happened fast, but there was a bit of a lag. You could still get used car and new car financing at a fairly low rate. I know people last year got adjustable rate mortgages, even 30-year fixed mortgages, still in the 2s and 3s. Again, that was first half of the year.
Sure.
But towards the second half of the year, all those changes, anything that was sensitive to higher interest rates really started to show through in a negative way. It's what we thought. But we also projected and predicted that inflation sometime in the summer was going to peak and start rapidly declining as the impact of higher interest rates found its way through the markets, the economy, so on and so forth. And that's exactly what happened. Right. So what we're illustrating here is we have this little box pulled out, and that is the next 6 months of monthly inflation data. Now, it's hard to see here, but the last 6 months of inflation data, the numbers that have rolled on, month over month changes, have been 0.1 to 0.4. And if you look at what is going to roll off,
correct, right here,
as the new months roll on, inflation is going to plummet. Now, it can only change monthly as the new number comes on, but inflation is going to decline rapidly. Mm-hmm. You're going to have a Federal Reserve who has been rationalizing their increases and higher interest rates based on a 7, 8, and 9% inflation number. Well, then what happens when inflation is 6, 5, 4, 3? You have a scenario where interest rates will be well ahead of inflation. And that rarely happens. And when it does, it doesn't stay there for long. And it's not that inflation comes up, it's that interest rates come down.
Right.
So the rationale and reasoning behind higher interest rates is going to fade away pretty quickly. Right. And I think you're going to see that every month throughout the year.
Correct. So with that said, that would mean that the Fed is likely done or close to done with raising interest rates, which is what created a lot of the volatility in both the stock and bond market last year.
Absolutely.
And I think maybe just to highlight that one step further, we have a slide here which is coming from the central bank in terms of their expectations.
Yeah, so this is the Fed themselves projecting that they're going to cut rates by a significant sum. This is what they put out every meeting, right? Nobody reads this, but this is what they put out. And if you look at their chart, their projection for interest rates, it's to actually cut down to 2.5% over the next looks like 24 months. The bond market, which is in green here, is saying that, hey, we think the Fed might have another 1/4 point increase in it, maybe. But during this year, by the end of this year, it's also pricing in the Fed cutting rates. And I would tell you, the bond market is right. I would say probably 90% of the time. It was right pricing in inflation being lower than most had forecasted. And I think it's going to be right again here, seeing that the Fed probably won't be able to increase rates by much more from here. Number one. Number two, they'll also need to cut rates sooner than they're forecasting.
Correct.
But if we just use the Fed's plot alone, you have lower interest rates, and flat and declining interest rates usually creates a bull market for stocks.
And just to clarify, the Fed expectations is the dotted blue line. The market is the green line.
That's
right?
correct.
And they're both going down.
They're both going down. One is not going up as much and coming down a lot quicker, but they're both, generally speaking, going in the same direction.
Okay.
Yeah,
That's
and if you're an equity investor, if you have money in stocks or the stock market, and of course we're probably doing that for you, that's a very good thing. You should be very optimistic.
Yeah, absolutely. Another reason to think that this year will be very different than last. Okay, great. And can you maybe transition a little bit? Let's talk about consumers, because this comes up a lot with the media. We hear a lot about how we've lost confidence, and that has been an indicator as well. If you can highlight what we're seeing there.
Absolutely. It's a contrarian indicator, right? So what that means is when the consumer is very confident, spending a ton of money, and nothing can go wrong, things usually go wrong. But when the consumer is very depressed and negative and pulls back a little bit, that's actually been a perfect indicator for positive markets 12 months out. So, we're looking at this, seeing that consumer confidence on the right-hand side, that dip that it took, reached a level that we haven't seen before in history. It was the most negative the consumer has been ever in history. And that usually creates a scenario where markets are much higher, usually 12 months out.
And Bob, when you say ever in history, you're including the financial crisis of 2008.
Absolutely. Absolutely. And that's when we had massive unemployment. We're even taking in consideration the pandemic, when you had peak health risk, peak financial risk, peak social risk happening. People were more optimistic during the depths of the pandemic than they were in September of this past year. Right. So that's quite extreme.
Yes.
But again, when we reach those extremes, that usually correlates to bull markets beginning.
Yeah, and I would highlight too the box on the upper right here, just to clarify what you were talking about, is that these previous 8 troughs of consumer sentiment, the average return of the market 1 year later has been about almost 25%. That's significant.
Absolutely.
Yeah, that's great.
Yep.
And if we could talk about the consumer maybe just a little bit more, because we do drive our economy. We're over 60% of our GDP. And I think this is an important piece of it.
Yeah. So when you talk about the consumer, there's been a lot of talk, the second half of last year, that the consumer is getting weaker. It's getting weaker. It's getting weaker. Well, yeah, it's getting weaker from a level where it was never stronger ever in history. So the consumer is still stronger than it's been measured over a long period of time. There is still excess savings. And this chart, hard to read, but we put it in here just to prove that there's still about 900 billion, or let's just round it up, $1 trillion of excess savings. And a lot of that came from the pandemic stimulus in 2020 and 2021, but it's still in the system. There's still $1 trillion of excess, which is why you still have consumption of goods and services. You still have travel. You still have packed airports. You have packed highways. You have a lot of economic activity. Why is that? Well, it's because the consumer is employed fully for the most part. There's excess savings, and you have, people worth near their all-time high when you factor in portfolio assets, real estate, and other assets that they might have.
Absolutely.
So the consumer is still pretty strong, and this is part of the reason why we're still quite optimistic. And we know the consumer will get a little weaker over time, over the next 3 to 6 months. But the Fed is also aware of that, which is why they're going to stop at some point, and that might be very soon.
Correct. And I think the other reason that we're optimistic about this is the low debt that we're still seeing.
Yeah, and this is where you just have to turn off the news, because the headlines you hear are, delinquencies are rising. Well, from what level? Well, from a level of no delinquencies, which is the lowest ever in history, to now there are some. Well, of course that's going to happen, whether that be credit cards or personal loans, really all consumer loans. But delinquencies are still near a record low, and we don't see them skyrocketing, period. So that is a very, very, very good indicator.
Absolutely.
So, 2022, the year of the bear market for just about every asset class, everything. Even commodities. Commodities entered a bull market in the first half of last year. They entered a bear market in the second half of last year. That's how extreme the change was last year. So, a bear market is really, let's just keep it simple for the equity market. It's a decline in close of greater than 20% from its high. And we had that in pretty much all the indices last year. And bull market is really an increase from the low point. And the low point of the S&P 500, aka the market, was just about 3,500. That was the level of the S&P mid-October of this past year, which was roughly a similar level when compared to June of last year. And a bull market will be created if the S&P 500 hits about 4,250. We're not too far away. We're about 300 points away, maybe even a little bit less after today. But we are approaching a bull market. Now, does that mean we're going to get there? No, it means we still might hover around. But once we get to that level where it's a close above 20%, we are technically in a new bull market. The best time to invest is not at the bottom. Is at the bottom, right?
And I think your comment is important because it's not going to feel like a straight line.
Absolutely. It's going to feel terrible when we say, when you feel awful and you're watching your portfolio decline and we tell you, hey, everybody, we're actually investing some of your money. You're saying, oh, no, please stop. No, we want to do that. That's what you have to do. That's how we get better than market returns over time, is we buy when everyone is running away. And these are the times to do such a thing, because these times don't come around that often. I know it feels like they're here all the time, but remember, bull markets tend to last 8 to 10 years. Bear markets last about a year, and it's been about a year. And
we know that one of the drivers of the return of the market comes from company earnings. And
absolutely,
despite the performance that we saw last year, when you look at the slide here, we still have earnings growth going forward that we're expecting.
That's correct. So a little known secret, the earnings of the S&P 500 for 2022 are going to come in above 2021. So you'll have an increase year over year in earnings, but you had a decline in the market. At one point, it was down, about 25%. It was down 25% because it was anticipating that this year, and it was early to anticipate this, but that this year earnings won't increase, they'll actually decrease. right? So
Right.
you already have the stock market really predicting many things. Number one, it is a prediction tool, right? It discounts all forward information and then it reprices as it's wrong. So it is predicting an earnings decline, it's predicting a recession, or it's pricing in a recession. So there's not that much more to price into this market. It's already priced it in.
Correct.
But when you look at earnings, number one, 2022 is an increasing earnings year, which is very rare to have positive earnings year over year in a declining market. That's number one. Number two, it's also, when you look at this chart, you have forecasts for earnings, maybe not for this year. This year, the forecast is a decline of about 10% in earnings. But you go out to 2024, 2025, so on and so forth, will you have these big increases?
Correct.
Well, yeah, because ultimately, if there's a weak economy, a weak market for a short period of time, these gigantic companies, the CEOs, the CFOs, the executives at these companies, they take the appropriate measures. They lay people off if they have to. They cut back on certain things and other expenses, and they find a way to either create new products, sell new products, take advantage of inflation, higher prices, so on and so forth. And generally speaking, they do, which is why you invest in good companies. And you can see this line on the left, this chart. If you draw a line at the trend, it's always higher.
Mm-hmm.
It's always higher. So again, another reason to be optimistic.
So we talked about all these reasons for optimism, but I guess we have to address this recession conversation that is still out there. And we have a couple of slides to share with on that as well.
So the recession, and we've talked about this. If you listen to these videos for the past 6 months, we've talked about a recession. Earlier in the year, we talked about a potentially a tough scenario for the National Bureau of Economic Researchers to call a recession. We had 2 consecutive quarters of declining growth in this country, but we didn't have weak unemployment. We didn't have weak consumer spending. We didn't really have weak industrial production. And we didn't have weak personal income. And those are things that are viewed, really the drivers of officially calling recessions. Now, there are real systemic economic slowdowns like the pandemic. That was an easy one because, well, the world stopped spinning and global economies were closed and nobody went to work, right? So you could see, if you zoom into this chart, there was a north to south red overlapping, everything's red scenario. That was a recession. And since then, there have been some red spots, but you need this vertical red across the board to really call a recession. And we don't have that yet. You could diagonally draw, a line and maybe get more red. So it's going to be a close call, whether or not we get into a recession or not. But that's all stale data, and the bond market knows that. Stock market, again, and television, they're just going to use this to get you to tune in. But ultimately, whether we're in for a soft landing or we just skirt by, it's going to be a close call. It probably won't be called until the end of the year, whether we're in one or not. And it's this happens all the time. When a recession is called, we're not in one.
We're out of it.
Just by virtue of how they have to call a recession, you still need your negative consecutive quarters, which means you need 6 months of negative data. And usually by the time that happens, you're already into an economic expansion. The recession calling and labeling is looking backwards, not forward.
Correct.
And it's never done live.
Yeah.
Which is why the bond market looks right through all of that stuff and, starts to put in some good positive indications. The stock market is very frantic and it's waiting for danger to happen all the time. And that's why a lot of people unfortunately get sucked into that vortex and you have bad behavior because everyone thinks a recession is what creates a negative market. It's not. It's declining earnings. So
Yeah, thank you. And I think just maybe one last comment on the economy and where we are right now. I think it's important to see what's transpired coming out of the pandemic, and if you can talk a little bit about that, about where that trend line that we're at.
yeah. So you have long-term economic growth projected out at 2%, and we've been plus minus that line since 2001, right? When we go a little above, we go a little below, and then we get back to sort of on-trend growth. The pandemic, which is that big spike down on that line, created a very massive decline in economic growth, and then it created a massive increase in economic growth. But we're still right at that long-term trend line, right? Here we are after the pandemic. After the Fed increased rates by way too much, way too fast, we still have this on-trend growth. It's because people and businesses have cash to spend. You might not want to spend it on things that are, 10 or 15% higher, but you're going to spend it. You'll complain about it, but you're going to spend it. You might not want to spend, 8% more on college tuition, but you're going to spend it. And the consumer and businesses are historically quite resilient. I would say more resilient, seeing that we had this pandemic infusion of capital mixed with this is a Fed-induced slowdown, not a real systemic issue. Things are still very good, and they're about to get better this year. Things will get a little bit worse, but then they're going to get better pretty quickly. So stay tuned. If you just project out using the Fed's rate that they're forecasting 24 months from now, you'll still have a very low interest rate environment. You're going to have a consumer that's still resilient. The Fed is trying desperately to create unemployment. I can't believe I'm saying that. And they can't do it. They just can't do it. Right. And they have a small window to do it before they have to stop increasing rates. They're probably not going to get unemployment to a level that's greater than 4.5%, which is a rounding error to zero whenever historically we talk about unemployment level. So we're going to have full employment. We're going to have soon a level of inflation that is back to 2 or 3%, rates that are low, earnings that are growing, dividends that are increasing, buybacks that are increasing. To me, those are all traits of a long-term bull market, and they're coming soon.
Great data points. And I appreciate you doing the summary for me. So thank you. But I think it's also just to highlight what you said, the dynamics of the market have changed so much in the last year. Hopefully people can hear from us that we sense a lot of opportunity for this year ahead.
Absolutely.
And as always, Bob, we appreciate your insight. We are here for you if you have any questions.
Absolutely. Thanks, Julina.